Hi students. I'm welcoming you to my class again. Once again, as we prepare for the examination, this is our final revision class. This is our final revision class. So I'm expecting you guys in class to be participating, to ask some questions. Actually, I would also like you to go deeper. I'm sure you have been exercising. I saw Ropio was also very busy. If you have encountered some questions, then you just feel free to share with me that a particular question or that area which you might feel like might be a challenge if it comes in. Unless otherwise, I will stick to the paper. The syllabus is simply the same. The questions are more like related. So let's practice more. Let's just run through the question and let's also we'll be discussing. I'm seeing that from last year they are bringing multiple choice questions. I'm sure we did some multiple choice questions. In our, I think, was it the fourth test, the final quiz, and as well possibly the first quiz on learning unit 1 and 2, which I feel most of these questions on question 1 come from there. Once again, let's look at question number 1. November 2025 paper. Question 1. Okay. Beverage Private Limited is a South African resident company that manufactures energy drinks. Beverage box year of assessment ends on 31 January 2025. The year of assessment, guys, is very important to know. Yes. Answer question 1 to 15 by either selecting the correct answer for the multiple choice questions or by choosing true or false. Okay, we can start with question 1. What does the question 1 say? The following entities people may qualify as micro business. Which of the following is incorrect? Which one is incorrect in terms of saying here? Which does not qualify as a micro business? A natural person or company, a natural person or trust, any company or close corporation, any natural person or close corporation. Remember, a micro business are those small businesses with a qualifying turnover which does not exceed R1 million. And micro businesses, from my previous class, I said it's designed for who? For poor, for people who are starting to, who are getting into business. Most of them are not very rich. So the one, I'm sure we also talked about the requirements for a business to qualify to be registered as a micro business. One of them is turnover, which should not exceed R1 million in a 12-month period. And once again, shareholders must be natural persons, and shareholders should not have interests in other companies. And as well, income from investments should not exceed 20% of that qualifying turnover. And it must not be a trust. So it's option B. Yes. B, a trust. Remember, trusts are for very rich people, and rich people often hide their assets in a trust. So all of the others can qualify to register as a micro business. I can be small, I can register a company, but a company also can, if the qualifying turnover does not exceed R1 million. they can qualify. But trusts, with trusts, it's common that trusts are used by rich people to avoid paying tax, to run away from tax, or as a means of reducing the burden of tax. Any question on that one? Okay.
No.
Number 2, which of the following statements about turnover tax is correct? Qualifying turnover refers to receipts only, not to amounts accrued. What do you say about this one, Ropiwa? They are looking for a correct one.
I see that it's false.
Not really. Qualifying turnover refers to receipts only and not to amounts accrued. Okay, it's fine. Let's read. B.
Okay.
Any natural person, company, trust, or close corporation with a qualifying turnover less than 1 million may elect to be taxed in terms of turnover tax system. What do you say about this one? This one is incorrect because of the trust. C. A company or close corporation is disqualified as a micro business if the year of assessment ends on the last day of February. Is it disqualified? No. So let's see. D. Taxable turnover includes 100% of receipts of capital nature. No. This one is also out. So they want which one is correct. So A is correct. Qualifying turnover refers to receipts only and not amounts accrued. According to the question that we did last week, it's also on YouTube, which I posted. It's the class which is trending right now. You will see. When calculating qualifying turnover, you only work with the cash receipts. So A is the correct one. A is the correct one. B is wrong because of the word trust. And C is wrong because of what? A micro business year of assessment should always end of February. If a company does have a year of assessment which does not end in February, will automatically be disqualified as a micro business. So this one is not correct because they are saying any company with a year of assessment ending on February would be disqualified. It's incorrect. Actually, all micro business year of assessment must end on the last day of February. D is incorrect because turnover exclude receipts of capital nature. Qualifying turnover excludes receipts of capital nature. Are we together? Are we all? Do we agree here? And saying yes, Rofia was right when she said A is correct.
Yes, we are
3.
clear.
Let's go to 3. Which of the following factors is not considered when determining if a receipt is of capital nature for the purpose of definition of gross income? Whether the receipt of capital is of capital nature or not, let me quickly come here. Whether a receipt is of capital nature or not, we must look at the tests. The courts established the tests. The reason why the courts and the SARS put these tests together, it's because it's a tricky part. Taxpayers doesn't want to pay tax. So they try to use that provision which says receipts of capital nature should not be included in gross income. Remember, you don't include the receipts of capital nature in your gross income. Capital nature receipts are those receipts from the disposal of fixed assets or disposal of non-current assets. So why using tests? It's because an asset can be fixed asset in my hand, but in Taviseng's hand is not. So the two tests which are used are subjective tests as well as, first of all, the intention of the taxpayer on disposing an asset has to be established. Let me find my router. Looks like the network is more like cutting. Okay. Can you hear me? Am I cutting a little bit?
No, it's fine.
Okay, thanks so much. So the intention is very important. From the intention, if there is to see whether there's a change in intention, because sometimes the intention can change, I can declare and say, I'm using my assets as fixed assets. But when you look at the activities I do as a company, it can show, the evidence would show that the intention has changed. So to establish whether the intention has changed, you look at these tests like manner of acquisition, manner of disposal, and taxpayers trade, period an asset has been held, accounting treatment, and then continue it. So these are the tests which we look at. So let's quickly go to the question and see which one is not considered when determining if a receipt is of capital nature for the purpose of definition of gross income. Intention of the taxpayer, yes. Intention of the taxpayer is there. Change of intention, yes. We said sometimes intentions do change. When you look at here, I said the change in intention is part of. And then the taxpayer's mind, no. Taxpayer's activities, yes. What do you do on a daily basis? So C is not a test. The SARS or the course are not going to work with what is in your mind, but they work with your intention on what you have done, or what you are doing, or what the business is saying. Your mind can be something else which is very different, but the intention, the statement of intent. So C is not. Let's quickly look at option number 4. Which of the following deductions is prohibited in terms of section 23, even though it may comply with the section 11A? Section 23 covers prohibited deductions. It must be read together with the general deduction formula, because you might have some expenses which might meet all the requirements of the general deduction formula, but however, they would be prohibited by section 23. Section 23 prohibits the deduction of things like bribes, fines, kickbacks, and so forth. The domestic and private expenses, the tax penalties and interests, insured expenses and losses, expenditure incurred on earning exempted income. provisions and some restraint of trade payments to companies. These are prohibited by Section 23, even though they might meet the requirement of general deduction formula. So, which one is prohibited? Costs incurred in maintaining a taxpayer. Any loss or expense to the extent that it is recoverable under any contract of insurance. Expenses incurred in respect of exempted income. Looking at this, all of them are prohibited. All of them are prohibited. Cost incurred in maintaining a taxpayer, this is more like private expenses. Insured expenses, which is coverable by insurance, it's those insured expenses and losses. Expenses incurred in respect of exempted income, we looked at it. All of them are prohibited. Therefore, option D. Question 5. The third provisional tax payment, then referred to as a top-up payment, is compulsory. Is this statement true or false? What do you say, Ropiwa, here on this one?
I would say it's false.
The third often referred to as a top-up is compulsory. Is this true or false? It's true, isn't it?
I said false.
You said it's false. Why are you saying it's false?
Because we already make the tax payments with our first and second provisional tax payments. So it's not compulsory to pay it for the third time, if that makes sense.
Remember, first provisional tax is paid on estimated amount. And second provisional tax as well, you normally use estimated amount. Remember, when it is payable? It's payable exactly by financial year end, of which by financial year end, the taxpayer might not have determined his exactly or right taxable income. So, third provisional tax is paid. It's more like it must be paid in a case amounts used in calculating second provisional tax is less than the actual taxable income. Remember, second provisional tax is payable exactly by the financial year of assessment. That's when it is payable. The company can actually get their actual taxable income a month or even 3 months after year end. So you end up having to pay third provisional tax. That's normally referred as a top-up payment. Is it compulsory or voluntary? It's compulsory, isn't it? Can we say I'm only worried about the wording when they say compulsory? Yeah, but it's compulsory. Something compulsory is not something which is something which has to be done. So I will say it's true. I'm sure you or anyone who wants to argue here, I might be wrong in terms of understanding the wording. But if you say something it's not compulsory, it means you can pay it if you want. Am I right? Something is not compulsory, means you pay it when you want. But I would say third provisional tax is payable. You have to pay it if the amount used for calculating the second provisional tax is less than your actual taxable income. That's why I'm saying this one might be compulsory. And if they say it's voluntary, then it will be something else. Anyway, let's look at the textbook. Let's look at the textbook, maybe. Because some of the wording might be in the textbooks. As I'm saying, I'm a bit worried about the wording which they want us to apply. Let's go to the wording. They might actually tell us, like, okay, I'm on turnover tax. I'm looking at which chapter covers provisional tax? Let's look at business entities. Business entities, 64. Yeah, here we go. Provisional tax payment, first payment, second payment. They did not give us more on paid provisional tax payment here in the textbook. Okay, we have got a long day. That's why we stop. But I will further check if there's different wording that might be used in different textbooks. Let's look at question number 6. With some limited exceptions, South African dividends received by or accrued to in favor of any person are generally fully exempt from normal tax. What do you say here again? What do you say about this one? I will say this one is false. Let's see. Oh, it's dividends. So with some South African dividends received by any, this one is true, sorry. With some limited exceptions, these are the dividends received from a real investment trust. But all dividends received from South African companies would be fully exempt. It is foreign dividends which are partially exempted. One of the requirements of the gross income definition is that amounts received must be of capital nature. Various tests have been formulated to determine whether amounts received are of capital nature. Which of the following scenarios would be considered not of capital nature? Which ones would not be considered not of capital nature? A taxpayer wins a prize on a radio station. A taxpayer sells his car to his neighbor. A taxpayer who trades in fixed property sells 3 residential properties. A taxpayer who sells the house in which he resides. Receipts of capital nature are generally those receipts from the disposal of fixed assets, or those receipts which are dependent on luck rather than effort, or rather than the taxpayer's trade. And lastly, those receipts from compensation, which is not related to the loss of income. Let me say, if a taxpayer is being compensated for defamation of character, that one is capital nature. But if a taxpayer is being compensated for the loss of income, let me say, I sue you, sign a contract, in terms of you sign a contract with me, like Mr. Madondo, I'm going to attend your tutorial class, and so much. So we are going to pay maybe 1,000 Rand a month. Then after signing a contract which is binding, you say, nope, I'm not going to be part of you. I can sue you. And then so that you pay me that amount which I was expected to receive from you. That one I should include in my gross income because it's related to the loss of my income. But you talk bad about me and then I sue you for defamation of character. That one is a capital nature. So I said receipts which are dependent on luck, like your lottery. Your lottery, it's capital nature. Disposal of fixed assets, as well as the compensation for defamation of character. So let's look at solutions. A taxpayer wins a prize on a radio. This one, we look at what is your trade as a taxpayer. If you win a prize as a radio presenter, then it can be included in gross income. But if I just enter into a draw at home, from home, then I won, or just I called and then I won, that one is capital nature. A taxpayer sells his car to his neighbor. A car is a fixed asset. It's therefore capital nature. A taxpayer who trades in fixed property, let's look at his trade. Somebody is buying fixed property and selling them. Then it's not capital nature because it's his trade. So it is a revenue in nature. The residential properties are more like his trading stock. A trading stock is a revenue in nature, it's not capital nature. Then a taxpayer sells the house in which he resides. Again, it's a fixed property. So the question is saying, which one will not be considered, will be considered as not of capital nature? Obviously, it's option C. Are we happy with this one? Anyone with a question, please feel free to ask. Question number 8. Which of the following requirements can be found in the gross income definition? Which of the following requirements can be found in the gross income definition, as well as the general deduction formula? I can say not of capital nature, isn't it? Yeah, this is the general deduction formula. You are going to see excluding expenditure and losses of capital nature, but it's fine. But the one which is already there is during the year of assessment. During the year of assessment, excluding of capital nature, not of capital nature, during the year of assessment. These are there on both sides. We go to gross income. You will see during the year of assessment and not of capital nature. They are found on both sides. So let's see which one. There is no during the year of assessment. During the year of assessment is on both sides, but not of capital nature is there. So our answer is option D. Question 9. The general deduction formula requires taxpayers to carry on a trade to be able to deduct expenses. Which of the following scenarios would not constitute the carrying on of trade? Yes. For a taxpayer to get a deduction, remember when you are calculating tax liability, there are a lot of deductions. So for you to apply the general deduction formula, for you to be able to apply the general deduction formula, the taxpayer should be carrying on a trade. That is the first thing. So what is regarded as carrying on of trade? Carrying on of trade can be you are running a business or you are working. That is a carrying on trade. Okay, that is carrying on of trade. What is not regarded as carrying on of trade is somebody who earns passive income. If you are earning passive income, you are not carrying on a trade. You will therefore not be entitled to deductions under the general deduction formula. What is passive income? Passive income, that's where you can put a fixed deposit somewhere and it brings you interest income. That interest income, it's passive income. You invest, you buy shares in a company. You are not involved in running the company, you're not managing anything. You just check you just go and send it there if the company is declaring dividends. So dividends are passive income. Interest income are passive income. So if you earning passive income, you are not carrying on a trade. So let's look at here. Which of the following scenarios would not constitute the carrying on of trade? The taxpayer who invests on the Johannesburg Stock Exchange and earns dividends from shares, this one, you are not carrying on a trade. The taxpayer carries on a business in construction. You are very busy, you are carrying on trade. The taxpayer owns a trademark and earns royalties by granting the right to use the trademark. So when you have your trademark, obviously you are some sort of carrying on a trade. The taxpayer owns several investments in the form of properties and earns rental income. If you are earning rental income, you are carrying on a trade because there's a lot of follow-up that you do. There's a lot of follow-up you must do in terms of maintaining the buildings. It's the same as the one person who has got a trademark, because you will be involved, very, very involved, designing your statements to make sure, so was there profit, was there any loss, what expenses are incurred. The same with the person who is running some properties, you are carrying on a trade. One who is not carrying on a trade, as I said, you invest in a fixed deposit or you buy shares and you earn dividends. And you earn dividends. So as long as you earn dividends, you are not carrying on a trade. So answer is option A. Ten, where a taxpayer buys a residential unit which represents only part of a building without erecting it or constructing that unit, or acquires an improvement to a residential unit, the cost for the purpose of calculating capital allowance is deemed to be 55% on the acquisition if it is a part, yes. If it is improvement, it's 30%. The cost would be reduced by such percentages before you apply that 5% allowance or 10% allowance if it is a low cost residential unit. So here it's true. So the cost would be cost multiplied by 55% if you buy a residential unit without erecting it. If there's an improvement you buy without erecting it, then when calculating capital allowance, you say cost of that improvement multiplied by 30%, and then multiplied by the percentage for allowances. So this one is true. Question 11. On 10 January 2025, Beverage Box Limited sold 500 cans to a retailer at 10 Rand each, 10, 15 Rand each. The cans were delivered on 26 February 2025, and the retailer paid 2,500 on the same date. The remaining 5,000 Rand was only received on 4 February 2025. Calculate the amount that will be included in the gross income of Beverage Box Limited for the year of assessment ending on 31 January 2025. Which one of the following is correct? What is gross income? So gross income simply amounts in cash or otherwise received by or accrued to in favor of the taxpayer. So whether an amount is accrued or received, that amount, the amount would still be part of gross income. So the 2,500 must be included in gross income. Let me see. No, the whole amount. Let me say the full amount. What is gross income? Let me calculate the gross income. It's simply the 500 cans multiplied by 15 Rand each. Anyone with a calculator to calculate for me? It's 7,500, isn't it?
Yes.
7,500, that is the gross income. So the fact that the other one was not and so forth, because the year of assessment ends in January. So including accruals, even though the amount was received after financial year end, the amount accrued to the taxpayer during the year on 10 January 2025. Any question on that one? Number 12. For capital gains tax purposes and according to paragraph 20 of the 8th schedule, the base cost of an asset includes only the original cost when the asset was acquired. Is it true or false here, of you?
I said true.
Near. So base cost is going to be original cost plus transportation costs plus installation cost plus any improvements, plus any improvements, plus selling costs, if you incur some legal cost plus legal cost as well. And less capital allowances. So in short, basic cost is not going to be restricted by the original cost. So you've got that cost, what is called the cost of an asset. It's purchase price plus any transportation or any other expenditure, including installation cost to bring an asset where it should be. That would be the cost a taxpayer would claim the capital allowances on. So on top of that, if you incur some expenditure when you were selling that asset, that selling expenditure, that selling costs should also form part of base cost. So the answer here, we can agree that it's false, isn't it? Because they say includes only, like nothing else, no advertisement when selling, not anything, no improvement. You only stick to the original cost, which is false. 13, the general wear and tear allowance obtained in section 11E on immovable assets should never be apportioned for a part of year of assessment. What do we say here, Opiwa? The general wear and tear should never be apportioned. What do you essentially say here?
It's true.
That is, this one is false. Because it say should never be apportioned. It must be, it's false. Remember when we looked at capital allowances, we said on other sections you don't apportion it. You only apportion where you apply section 11E, the general wear and tear. Here we say, yeah, where an asset was partly used for private purposes, you apportion. Where an asset was not used for the whole year, you apportion. So that one is false. The definition of asset in paragraph 1 of the 8th schedule includes which of the following is incorrect? Property of whatsoever nature, movable or immovable. Currency, tangible and intangible assets, rights or interests of whatever nature in such property. What is the definition of an asset? Which one of the following is incorrect? Which one is incorrect here?
Isn't it B, sir?
Yeah, I think it's B. I think it's B, like currency.
Yeah, because looking at the other three, of which they include property or immovable
Yeah.
assets, I presume those are those would fall under the definition of assets.
Yes, definitely. Let's look at question 15. Beverage Private Limited
Mr. Madondo, you
purchased
wrote C.
an office building. Okay, what did I say? Okay, B, sorry. So thanks. Beverage Limited purchased an office building on 1 April 2008 and subsequently sold it on 30 November 2024 for 5.8 million rand. All costs incurred for this building are as follows. Purchase price, transfer duty, valuation costs, repairs and maintenance. Which of the following costs will not be included in the base cost? Which one will not be included in the base cost? For capital gains tax purposes. Repairs and maintenance definitely will not be included in gross income. Repairs and maintenance, that is the one which is not going to be. Repairs and maintenance does not form part of base cost. They don't increase the value of an asset. Yeah, the rest, like a transfer duty, you can take it into account. Like, okay, so, but repairs and maintenance. Remember, an asset should be where it is to work. If something happens, it has to be repaired to work for it to be brought into use. So if you repairs should not form part of base cost. How much is the amount on repairs? 160,000 rand. Option A. That is it. Any question before we move on to another part? How far are you guys with the provisional tax? Should we do provisional tax? Question? I'm sure we can quickly run it through to remind you.
Yeah, I think since this is probably the last session before we write the exam, we can run through it. I'm not too sure if Rofi have you saying.
So yeah, there are some two recordings which I did on provisional tax, but let's run it through it to remember, so that at least question 2. Hello, Ropo, do you have a question?
I was just going to ask about maybe doing question 5 because it's not that long as well. Because I don't think we've ever done tax liability with you.
Or turnover tax?
Question 5. Yeah.
Didn't we do it last week?
I think last week
No.
we only did CGT.
Oh, turnover tax. We didn't do turnover tax last week together with CGT.
We did.
Yeah, we did this one. Yeah, but we are going to do it so long. It's fine. Let's quickly do provisional tax and then we move on to here. Let's do provisional tax. Beverage manufacture every drinks. The manufacturing process has been approved by SARS, and the company is not a small business corporation as defined in the Income Tax Act. Beverage box CA of assessments end on 31 January 2025. The following information is available. The notice of assessment for the 2024 year of assessment was issued on 25 July 2024, and it reflected a taxable income of 847,526 rand. The notice of assessment for the 2023 year of assessment was issued on 15 May 2024, and it reflected a taxable income of 785,259 rand. So here we go. First, provisional tax. What is the payment date of your? We have to see what is the company's financial year end. It ends on 31 January. Remember, first provisional tax is payable 6 months into the year. What is the payment date in terms of year? The payment date for first provisional tax. Remember, payment date is very important. So if the company's financial year end is 31 January 2025, it means the year began on 1 February 2024, isn't it? So let's count 6 months from 1 February 2024. So we're going to say February, March, April, May, June, July. So it's payable on 31 July 2024. So let's look at the basic amount. So remember, the basic amount is the amount which you should use to calculate first provisional tax. Generally, it's based on previous taxable income, provided that it was assessed in more than 14 days before the payment date. So if we are calculating first provisional tax for 2025, we should quickly look at the immediate previous year of assessment, which is the 2024 year of assessment. So we see the 2024 year of assessment was issued. Yes, remember the basic amount that taxable income should have been assessed. Was it assessed? Yes. On which date? 25 July. Remember, we said it should have been assessed in how many days, Ntaviseng? More than
14 days.
Before payment date. So our payment date is 31 July 2024. But this one was assessed on 25 July 2024. So we can write the 2024 taxable income may not be used. Let me say cannot be used as it was assessed in less than 24 days, and less than 14 days before payment date. Which would usually, we can say from 25 July 2024 to 31 July. It's less than, way less than 14 days. Remember the rule the rule is simply that previous year taxable income, it should have been assessed more than 14 days on payment date before the payment date. So if we can use the 2024 taxable income, we go to the 2023 taxable income. Do we have the 2023 taxable income? Yes. Was issued on 24 May. So this one can be used. Should it be adjusted? Remember, we can only adjust it if it is older than 18 months on payment date. If you are standing on 31 July 2024, how old is the 2023 taxable income? So let's count the number of months from year end 2023. That is from 31 January 2023 to 31 July 2024. I'm sure it's exactly 18 months, isn't it? It's exactly 18 months. You don't adjust if the previous year taxable income is not older than 18 months. It's exactly 18 months. So no adjustments should be made. So we can use the 2023 taxable income. How much is it? 785,259 rand. Before we can say it's final, let's see if there is no taxable capital gain in the amount. The rule says if that previous year taxable income includes taxable capital gain, the taxable capital gain must be subtracted. I'm sure you might have seen some questions like that where there is taxable capital gain. So if there is taxable capital gain in it, it must be subtracted. Or if it is for natural persons, amounts like lump sums. So why are we removing taxable capital gain from a previous year taxable income? I'm sure you can guess the reason. The reason is if it includes taxable income, taxable capital gain, it is not accurate as such because you don't sell assets each and every year. I'm sure you know that taxable capital gain is from the disposal of fixed assets. So if we are using it for provisional tax, we have to subtract that taxable capital gain because the company or the taxpayer is not going to sell assets each and every year. Even if they do sell assets every year, they are not going to sell them at the same amount. So in simple terms, if the basic amount includes taxable capital gain, then the taxable capital gain should be subtracted so that you have got an amount excluding taxable capital gain. I'm sure you can hear me loud and clear. Okay, so now let's calculate tax at 27%. How much is 27% of the amount? Somebody to calculate for me quickly. $212,020. Then remember, first provisional tax you have to pay half. Remember, it's payable after 6 months. You must pay half of that. It's going to be 212,020 rand multiplied by 50%. You must pay half of the estimated tax. How much is the amount? The first provisional tax which beverage box should pay on 31 July 2024 is 106,010 rand. That is it for first professional tax. Any question? Anyone with a question? Okay, I was just quick. I did not see the framework they say here. But anyway, it's fine. So the reason which you can put here when answering this using this format, yeah, this one we are not going to use the 2025 estimated taxable income because for first professional tax you use basic amount, and then 2024. I'm sure we have said it. The reason why we are not going to use it as the basic amount, it's because the date of assessment, the notice of assessment was issued in less than 14 days before payment date, and then we rightfully used the 2023 taxable income. That's what we used. Then let's look at B, part B. Said calculate second professional tax payment that beverage box limited must make for its 2025 year of assessment in order to avoid becoming liable for penalties and interest. Also indicate the date by which the payment must be made. Is payable on which date? Second professional tax should be paid by the financial year end, by the end of the year of assessment. So meaning is payable on 31 July, 31 January, sorry. 31 January 2025. So let's try and see, they said use this format. Let me try and use the format and see how far we will go. 1, 2, 3, 4. Let's see, taxable income. Date of assessment. And then reason. $20.25. Let's see. Let's see. Let me go to this. The lecturer wants to punish us by drawing some tables, some necessary tables. Mhm. Get estimated. Then what was the reason? And let's go to the next one. So for second provisional tax, for second provisional tax, the amount you should use, it depends on the estimated taxable income. We'll ask, do we have the estimated taxable income? Yes, it's there. It's 850,000 rand. So if the estimated taxable income for the year is below R1 million, the amount used for calculating a second provisional tax is the lower amount between the latest assessed taxable income, which would be in this case for 2024, and the estimated. So the lower amount should be used. Not to be used. It's more than. How much is the 2024 taxable income? 847,526. Let's just look at the 2023. Mm. $785,259. May 2025, 2024, sorry. And this one is 2024. So we said this one can be used. Not to be used. Not the latest assessed taxable income. Before payment date. That is the reason. Remember, we use the most latest one. The 2024, we couldn't use it for first provisional tax because of the date issue. But at 31 January, the 2024 taxable income is now way more than 14 days. Is now way more than 14 days. It can qualify to be used. But since we do have the estimated, the amount which we should use is the lower amount between the basic amount and the estimated taxable income. Our basic amount is the lower amount. Therefore, that's what we are going to use, the 24 taxable income. Okay, let's do the calculation. Which is the basic amount. We said it amounts to how much? It's 847,526. Tax at 27%. How much is 27% of this amount? Somebody to calculate for me. I'm getting 228,832 rand. Remember, we've already paid the first provisional tax. We can now subtract the first provisional tax. Which was paid. How much is the first provisional tax which we paid? It's 106,010 rand. Okay. So how much is the tax? How much is the second professional tax payable? So here is the second professional tax payable. I'm sure we are fine with the second professional tax. Any question we might have? I'm sure, Rofua, you do have some questions. Questions are good.
No, I'm okay.
Yeah, okay. Do you understand every step which we went through?
Yes, I do.
Okay, thanks. How about Tsepan?
So with regards to the second provisional tax, I was a bit lost because now we had to use the table. We had to obviously follow the instruction. So I
Yes.
got lost as to how you went about getting that 122,000. Can you please maybe explain that?
This one. You say which one are you worried about? The 122,000?
Yes, the second provisional text. I remember we did the first provisional text and you showed us the steps. So with the
Yes.
second provisional text, I'm not too sure. Can you please explain the whole process?
Okay. Yeah, now I was now following the instructions which they said we must use. Where I said, but the general rule is which amount are you going to use for second provisional tax? For the first, we said you use the basic amount from the previous year, provided it was assessed. But for the second, you have to look if there is any estimated taxable income. Yes, it's there. So the rule is if the estimated taxable income for the year, remember it's for 2025, for the year, is less than R1,000,000, the amount which you should use in determining your second provisional tax is the lower amount between that estimated taxable income and the basic amount. The basic amount is the most recent assessed taxable income. So between these two, you can see the recent assessed taxable income can be used, should be used, because it's lower than the estimated taxable income. And we said the 2023 we cannot use it because you use the most recently assessed taxable income, provided that it qualify. We can only jump to the 2023 taxable income if the 2024 taxable income does not qualify to be used, just like what we did with the first provisional tax. So after we have determined that this is the amount which we should use, the 2024 taxable income, the 2024 taxable income, again, we cannot adjust it because you look at then how old is it from 2024 to 2025. It's only 12 months. You adjust it if it is older than 18 months. So yes, if we are going to use it, it's a symbol. This is the amount which we are going to use. We simply calculate tax at 27%, the rate for companies. This is the rate. After we get the tax for the year, this is the estimated tax for the year, for the whole year. But we should keep in mind that after 6 months, we had already paid the first professional tax. So this first professional tax paid should now be subtracted from the estimated tax for the year for us to be able to get the second professional tax payable. So I'm sure you are doubting the difference between here we said 50%. Remember, we must pay half after 6 months. Why now are we not saying divided by 2? Because this is after 6 months we pay half. And second provisional tax is after 6 months, after 12 months. This is for the whole year. But we should subtract what we have paid after 6 months to get the amount which we owe to SARS as second provisional tax payable. Is it now better?
Yeah, makes sense.
Yeah, just ask a few if there's anything which you feel like here and there we try to strengthen up. I'm sure Ropio is here, can help us as well. So if it makes sense, I'm also very happy. I'm sure we all like to do this question. We haven't done it in a few. We haven't done it to quickly run through it. Unless you guys says we are fine, we want to do taxable capital gain. But anyway, we will simply run through it. And we have done a number of exercises by now. Let's do question 3. Part A. Beverage Limited. Its manufacturing process has been approved by SARS, and the company is not a small business corporation. The year end on 31 January 2025. And where should we start our question from? Calculate the taxable income of beverage box. Mm. 31 LTD for the year of assessment ended on 31 January 2025. Okay. The question simply says ignore taxable capital gains tax. You must commence with sales. Don't start with the profit before tax, but start with your sales, which is fine. Provide the reasons for any amount that is not taxable or deductible. Okay, like they said, we know the financial year end. We know that the company is not a small business corporation. So they said we must start with the sales. On sales, we don't have any note. We know sales must be included in a gross income. Sales have to be included, which is 6,255,000 rand. That's what we should start with. Number 2, on cost of sales. We need to know how we account for cost of sales. A lost on here, it's subtraction. Remember, we start with the statement and then we run to the notes. We go to the statement and then we run to the notes. Cost of sales, we know the components of cost of sales. It's a inventory for the year, opening stock, and closing stock. Those are the components. So let's go to the notes. On the cost of sales, we are seeing opening stock. Generally, for tax purposes, opening stock for the year must be subtracted, but should be subtracted at the lower amount between cost and market value. What we see is the cost. Do we have any market value here? Market value we are seeing is in respect of closing stock, but we want opening stock, which we say must be subtracted. Well, we simply subtract it as given at cost. Let me remove it cost because they don't. It's fine. We must subtract it. How much should we subtract as opening stock? 2,565,500 rand must be subtracted. Purchases. You should just know that purchases are subtracted. Purchases is stock that was purchased during the year. Yes, the purchases must be subtracted. The amount on purchases, as we see, is 1,855,000 rand. Here we go, 1,855,000 rand. Then we've got closing stock. What should we do with the closing stock, Ntavise?
We add it.
Yes. But at what value?
Market value.
At the lower amount between the two. At the lower amount between the two.
Oh, sorry.
Which one is the lesser amount? At cost. The cost price is less than, or let me say is lower than the market value. So now we are going to add how much? 2,384,600 rand. Yes, we don't put in brackets. We saw that the market value is more. So we account at the lower amount, at the lower value. I'm sure we are all happy here. We go to other income. Remember to follow if you are given a statement of comprehensive income like this, you just have to follow it. On other income, I'm seeing there's interest and there's dividends. Interest income must be included, and that we don't have any exemption. How much is the interest income? 556,000 rand. Interest must be included. This income must be added. Dividends. South African dividends. Also, it's part of gross income. They must be included and added at what value? 325,400 rand. But remember what we have discussed on the top. We said all South African dividends are fully exempted. Isn't it, Rofio? We said South African dividends are exempted. So when we talk about exempted, it means we got grace. It was supposed to be taxed. It was supposed to go to hell. But SARS said, no, we are going to exempt it from going to hell. So we must subtract exemption on the dividends. Local dividends are fully exempted. So we must include it and then subtract it in full. That's what you should do. That's what the lecture wants us to do. Don't simply omit it and say it's exempted. I'm going to jump. You must disclose. You include because it's part of gross income. Dividends are part of gross income. And then later on you subtract because it's exempted. Anything else? That's what we're given. Then we are fine. Then we go to the expenses part. Let's go to the expenses part. And we'll put it a little bit in block. Anyone with the questions, please, if you have got questions, feel free to ask. Remember, this is one of our last classes. So don't just die inwardly. Please ask. Then we can discuss further. If you don't ask, I simply assume that everything is clear. Okay. Under expenses, we go to contributions to pension funds. Contributions to pension fund on behalf of employees are allowed as a deduction. However, I'm seeing the note. When you see a note, don't ignore a note. Go to the note and see what does the note say. The note is saying contributions to pension fund were made in respect of all the employees. The contributions were deducted from employees' salaries and paid to the fund. Are you seeing what are you getting what I'm getting here? The contributions to pension fund were made in respect of all the employees. The contributions were deducted from employees' salaries and paid to the pension fund. So this one is not allowed as a deduction. This one is not an expense for the company for beverage because they were deducted from the employees' salaries. Hence, I'm saying don't ignore the note. If we just memorize, like, okay, when it is like this, we're simply going to subtract. Remember, the contributions that are allowed as a deduction are those made by the company on behalf of the employees. The contributions were made by what? By the beverage on behalf of their employees. This one, beverage is simply paid salaries to their employees and deduct from their salaries and then pay. Then it's not an expense for beverage, but it's an expense for the employees. What is allowed as a deduction, it's an expense by the taxpayer. But this one is an expense of the employees. So it's not allowed as a deduction. I'm sure it's clear in this one. So it was deducted from employees, from the employees.
Mr. Matondo.
Hello?
According to section 11, I, is it I or L? It says the contributions to employee benefits like pension fund, provident fund, or medical aid are fully deductible.
Yes, but if they were made by the company, that's where the difference is. If the company paid them on behalf of the employees, if you have printed my notes, you can add that. You can add if they were paid by the company on behalf of employees. Look for those words when you are answering the question. So
yeah,
here,
this is where they trick us.
But here they said deducted from employees' salaries, meaning it's an expense to me, an employee.
Yeah, and it was deducted from your salary.
From my
So
salary.
we are not deducting it on the company's. Yeah. Okay.
Definitely. So this one it's not from the company. It's not made by the company on behalf. Look at the word made by the company on behalf of the employees. Then that's the one which is allowed as a deduction. Net salaries. Yeah, the net salaries will be allowed as a deduction. So what we would say, we'll just say net. Remember, net salaries is after deducting the other things. So what we get is salaries. So the salaries would be net plus contributions. To fund. Remember, net it's what was actually paid to employees after tax and other things. So we must take the funding into account and deduct it as full salary, which is 625,000 rand plus 254,000 rand. That's what will be allowed as a deduction, as full salaries. Yeah, 879,000 rand would be allowed as a deduction. 879,000 rand would be allowed as a deduction. Are you also satisfied here, Tsepan? What is allowed as a deduction is full salary, not net. Yes. So where is the other? The other one is that fund. Remember, we were told that after deducting from, so both must be added together to get the salary, which is allowed as a deduction in accordance to the general deduction formula. Let's look at the provisions for doubtful debts. So for provisions of doubtful debts, what do we get as a deduction in Ropio? There's one we see provision for doubtful debts. Let me read provisions of doubtful debts. It's not number 4. The company does not apply IFRS 9 for financial reporting purposes. And the debtors clerk indicated that the list of doubtful debts for the 2025 year and amounted to 678,000 rand and is not in arrears for more than 100 days, but less than 120. The list of doubtful debts for the 2024 year and amounted to 1,358,000 rand and has been in arrears for more than 120 days. Okay, for once if there is a doubtful debts, the taxpayer would be entitled to a doubtful debts allowance. So there's a doubtful debts allowance. So in respect of doubtful debts allowance, we've got the allowance for 2024 for the previous year must be added. It must be added. The allowance for the previous year must be added. And the company does not apply IFRS 9 to their reporting. So if the company or the taxpayer is not apply IFRS 9, the allowance will depend on the number of days in arrears. If that doubtful debt is 60 days and above, but less than 120 days in arrears, then the allowance would be 25% on that list of doubtful debts. But if that list of doubtful debts is in arrears for days which are 120 and above, there is an allowance of 40%. That is it if the company is applying IFRS 9. If the company is not applying IFRS 9 to their reporting. But if the company is applying IFRS 9, then the allowance would be based on loss impairment, So if the loss impairment is measured according to lifetime credit loss, the allowance on that impairment is 40%. If it is measured according to lifetime credit loss, then the allowance is 40% on that impairment. But if it is not, if the impairment is not measured according to lifetime credit loss, the allowance would be 25%. That is if the company is applying. Our case, our taxpayer here is not applying IFRS 9 to their reporting. So now we look at the number of days in arrears. The allowance for previous year must be added. We got it as a deduction in the previous year in 2024. Now in 2025, we must add it. We were not given a straight allowance. They simply give us the list of doubtful debts, but we can calculate the allowance. We said it was 1,358,000 rand. How much allowance should we use here, Tavi? What percentage are we going to use for 2024? They were in arrears for more than 120 days. The allowance, therefore, it's how much, Ropiwa?
40%.
Yeah, 40%. Thanks so much, 40%. So how much
40%.
allowance are we going to add? How much are we going to add? It's 543,200 rand must be added. Then, yeah, doubtful debt allowance. For 2025, which is the current year. We said the number of days in arrears are less than 120, are below 120. So the allowance would be 25%, isn't it? So it's 678,000 rand multiplied by 25%. The allowance for the current year must be subtracted. 169,500 rand. So here we go. Do we all agree? Are we all happy? Any question?
With this one, getting a bit it's getting a bit trickier. I think maybe the principles or hey, yeah,
What is tricky and Tsepan?
The 40% and the 25%.
Okay. If the doubtful debts older than 60 days, but not more than 120 days, the allowance is 25% on that list of doubtful debts. But if that doubtful debt is more than 120, like here, the previous year was more than 120 days old, then the allowance would be 40%. How is it now?
Oh, yeah. I think maybe I did not catch while you were explaining it. But
Okay,
yeah,
but now it's clear.
since now you say if it's less than 60 days.
If it is less than the 60 days, it's not doubtful. No allowance.
Oh,
The debt becomes doubtful if it is 60 days and above. If it is from 60 but less than 120 days, you get an allowance of 25%. If that doubtful debt is 120 days and above, then you get an allowance of how much it's a plan? 40%.
40%. Okay.
If it is less than 60, no allowance. It's not doubtful. How is it now? Better.
Yeah, I think I'm going to have to repeat this recording so that I can easily understand. Thanks.
Now, but you must understand now, you rather sleep here and have class tomorrow. You just ask any area you feel you don't understand for the benefit. You might be surprised, like Rokyo is also not understanding, Sepang and Tabiseng is also not understanding. So you can find different angles. I know sometimes your mind can go deeper than where we are. It's good. You can simply ask so that we provide clarity. Okay, we are done with the provision of doubtful debts. Let's go to the legal expenses. So with legal expenses would be allowed as a deduction on two conditions. One condition, they should have been incurred in the production of income. We don't want a taxpayer who would take money from the company to pay legal fees for their employees or for their wife or somebody else outside the business. Those legal expenses will not be in the production of income. So I said one condition, they should be in production of income. They should have been made incurred in the production of income. Two, they should not be capital nature. So if they are capital nature, when we talk about capital nature, it's like you incur legal costs when you are acquiring fixed assets. Those legal fees would be capital nature, would not be allowed as a deduction if they are capital nature, or if they are not incurred in the production of income, they won't be allowed as a deduction. So now let's quickly look at the note number 5. Here are the legal expenses. We've got one relating to collection of trade debtors. Relation to the collection of what? Trade debtors. So this one, it's allowed. It qualifies as a deduction. So there is an incurred in the production of income. incurred in the production of income. So they will be allowed as a deduction. How much is it? 9,650 rand would be allowed as a deduction. Then let's look at paid on behalf of the company's director. Director. Paid on behalf of the company's director. This one is more like a private, not incurred in the production of income. So it's not going to be allowed as a deduction. And once again, it's a loan to him. It's fine. Are we clear here? Let's see, what does the notice say after that when there's a depreciation? For tax purposes, we don't work with a depreciation when we see fixed assets. But we've got capital allowances. We have to determine the capital allowances, and then it's the capital allowances which would be allowed as a deduction. There's machine X. So once we see assets, we talk about capital allowances. That is the reason why we have to be careful whether the company is a small business corporation or not. Let's quickly go to my notes. If the company is a small business corporation and an asset is a manufacturing asset, the capital allowance is 100% in the year the asset has been brought into use. But if it is a non-manufacturing asset of a small business corporation, write-off is in 3 years. 50% on the cost in the first year, 30% on the cost in the second year, 20% on the cost in the third year. You don't apportion it. Remember, I said you only apportion where you apply Section 11E. So if a company is not a small business corporation, that's where you come here. Yes, it's not a small business corporation. And machine. So let's read more about the machinery. So it was directly used in the manufacturing process, was purchased new on 1 January 2025 during the year. It was brought into use in the same date. Yes. So machine X. Capital allowances. It's still in use. It's 345,000 rand. How much allowance are we applying in Taviseng? Yeah. It's machine X. The question is, was it purchased new or second hand? It's a manufacturing machine. The process of manufacturing was approved. If it was purchased new, you claim your capital allowances in 4 years. 40% in the first year, in its first year, and in the remaining 3 years, it's 20% per annum. If the manufacturing asset was purchased second hand, it becomes 20% per annum. So this one was purchased new. Was it purchased during the year? Yes, remember our year is ending in January. So it was purchased. This is the company's first year to use this asset, and it was definitely used. The allowance is going to be 40%. So how much is 40% of 345,000 rand? It's 138,000 rand. Now let's quickly go to a new computer. A new computer. New computer. We know a new computer is not a manufacturing asset. And we already know that our taxpayer is not a small business corporation, and it's a movable non-manufacturing asset. We will therefore use the provisions of Section 11E, where we get our wear and tear allowance by dividing the cost by the number of years provided. And if the asset was not used for the whole year, you are further apportioned by the number of months the computer was used during the year. So let's look when it was purchased. It was purchased during the 2024 year of assessment and was brought into use in the same day, meaning, yes, they apportionate in 2024, but during the year, this year, it was used for the whole year. We are not going to worry about apportioning because it was used for the whole year during the current year. So what we'll simply do is 30,000 divided by the number of years. What is the write-off period for computers? 3 years. Therefore, there's 10,000 rand wear and tear allowance to be subtracted. Are we fine? No apportionment, because during the 2025 year of assessment, that computer was used for the whole year. It was only in the 24, the previous year, that's when they were apportioned. But now we are in the current. In the current year, we used our computer for the whole year. Let's look at the delivery vehicle. Delivery vehicle. So let's see what happened. It's another non-manufacturing asset. We see there was a disposal because it was involved in an accident. So meaning if there's a disposal, there are two implications. It's either there's a loss which translates to scrapping allowance, and the scrapping allowance would be allowed as a deduction during the year. But if there was any amount received, and the amount received was more than the tax value, then we would worry about looking at a recoupment that must be added when calculating tax payable. So we see this disposal on the vehicle because it was scraped off. So what we need to do is to get the tax value. If no money was received from the insurance company, then we do have a scraping allowance because the vehicle would have been thrown away with its tax value in it. So let's look at it. Cost. How much was it purchased for? How much was? How much?
365.
365,000 rand. We need to, for us to get the tax value, we must subtract all the capital allowances claimed. Which year of assessment was this delivery vehicle brought into use? Which year of assessment was this delivery vehicle brought into use?
20.
Yeah, during the current year. Remember, we said our 2024 year of assessment is running from 1 February 2024. So it's this year. That's when it was brought into use for it's wear and tear 2025, which is 365,000 rand divided by how many? How many years for delivery vehicles? 4.
4.
Remember, was it used for the whole year? We see that we see that when it was purchased, it was purchased on November 2024, and then on 31 January, it was scraped off after an accident. How many months was it used during the year? It's November, December, January, isn't it? Yeah, January. So it was only used for 3 months. Do we all agree? November, December, and January. So remember what section 11E says. If an asset was not used for the whole year, you apportion. So the allowance by the E&T must be apportioned. You multiply by 3/12. How much do we get? Remember, you only do this on movable non-manufacturing assets of a company which is not a small business corporation. That's when you apportion the allowance if the asset was not used for the whole year. I'm getting the E&T of 22,813 rand. Now let's get the tax value which was scraped off. Let's get the tax value which was, this is the tax value. So this value was thrown away. A company made a loss here. Remember, we said a loss on the disposal of assets would result in scraping allowance, section 11O, which would be allowed as a deduction. So there's a scraping allowance. Scraping allowance of how much, which is exactly the same amount as the tax value. Yeah, I'm sure we are done. That is all. Do we have any other areas which we might have omitted? I'm sure we are done. Yeah, we are done. Yeah. I think we need to stop these classes. I don't want you to have a very long recording, isn't it, Tsepan?
Yeah.
Don't want a recording of 4 hours.
Yeah, it's understood.
So let's break for how many minutes? How many minutes do you need, guys? How many minutes do you need, Ropiwa? Ropiwa is left. Saying, how many minutes do you need?
I think it's 15:15 now.
10 to 15.
10
Yeah.
minutes, isn't it?
15, 50. I think at 15:30 we can comment again.
Yeah, 15:30 we can comment and then we look at these remaining 2 questions.
Okay.
Okay, thanks, guys. See you in our next meeting again. See you in our next meeting. Subscribe, share, and subscribe.
Okay.
Okay. And share to all those telegrams so that I also have a number of people following me, so that everyone can benefit. That's the only way you can repay me. So let me add, and then we get what the lecture wanted here is taxable income. So we are going to add and subtract what is on this column and see how much is the tax. What we are going to get, it depends. If it is a loss, it's going to be an assessed loss. If there is a profit, it is positive, then it's going to be taxable income. It's positive, then this is the taxable income. Taxable income. Okay, let's break, and then at 8:30 we start again after uploading this. Thanks so much, guys. Next time, next 15 minutes.